What if retiring early wasn't about picking the perfect stock? What if it wasn't about predicting the next market crash? And what if it didn't even require selling your investments to survive? Most investors are taught the same story. Work for 40 years, max out a retirement account, hope the market behaves. Then, sometime in your mid-60s, slowly draw down your portfolio and pray you don't outlive it. But that story leaves out something critical. It ignores what happens when you actually need income. Not someday, but soon. It ignores the psychological damage of watching your portfolio shrink while you're forced to sell shares in a down market. And it ignores the fact that many investors make the biggest mistakes, not because they lack intelligence, but because they lack a system. This video is about what happens when someone builds that system. Not overnight, not without mistakes, and not without learning some very painful lessons the hard way. There was no early start, no perfect timing, no secret information. In fact, some of the worst investing decisions happened right at the beginning. Selling during crashes, moving long-term money to cash, and missing out on years of compounding that can never be recovered. And yet, despite all of that, the result is a portfolio capable of generating hundreds of thousands of dollars a year in income without selling shares and supporting retirement years earlier than most people ever imagine. How does that happen? It starts with one realization most investors never fully internalize. If you're not at least matching the market, you're falling behind. From there, everything changes. Broad market index funds become the foundation. Growth becomes intentional instead of accidental. Cash stops sitting idle. And eventually, the focus shifts from simply growing a portfolio to designing one that can actually pay you consistently, predictably, and sustainably. That's where most investing advice falls apart, because generating income without destroying your principal is hard. Chasing yield usually leads to regret. And selling shares during retirement creates risks no spreadsheet can fully capture. But there is a middle ground, a strategy that blends market exposure with income generation, a way to use options not as speculation, but as a tool, and a framework where monthly cash flow becomes a feature, not a liability. This video breaks down that framework. We'll walk through how a portfolio evolved across multiple market cycles, why certain strategies were abandoned, and how covered call ETFs, when chosen carefully and monitored correctly, became the cornerstone of an early retirement plan. We'll talk about why some high-yield products look attractive but quietly erode your wealth, why principal preservation matters more than headline yield, and how tax treatment can make or break an income strategy long before the IRS ever gets involved. Most importantly, we'll show how income and growth don't have to be enemies. You don't have to choose between letting your money run and living off it. You don't have to gamble on ultra-high yields, and you don't have to wait until 65 to design a life that gives you control over your time. This isn't about getting rich quickly, it's about getting intentional. It's about building something durable, and it's about learning, before it's too late, what actually matters when your portfolio has to work for you, not just look good on paper. If you're early in your journey, this may save you years of mistakes. If you're close to retirement, it may change how you think about income forever. And if you've ever wondered whether it's possible to step away from work without selling your future, this is a video you don't want to miss. For most investors, the idea of retiring early on portfolio income alone feels unrealistic. Traditional advice often centers around working until the mid-60s, slowly drawing down savings, and hoping market returns cooperate. But occasionally, real-world examples emerge that challenge those assumptions, not through speculation or luck, but through discipline, patience, and a deep understanding of how different investment strategies actually work. This script explores one such framework, a long-term investing journey that evolved through multiple market cycles, painful mistakes, and hard-earned lessons, ultimately leading to a high-income portfolio capable of supporting early retirement. The strategy combines broad market index investing, selective growth exposure, and a significant allocation to covered call ETFs, designed to generate substantial monthly cash flow while preserving long-term capital. Rather than presenting a theoretical model, this discussion is grounded in lived experience, highlighting what worked, what failed, and why certain strategies were adopted only later in the journey. The result is a realistic look at how an investor can transition from accumulation to income without abandoning growth altogether. Early investing. Learning the hard way. Like many investors, the journey began later than ideal. Investing did not start during adolescence or early adulthood, but after graduating college in the early 2000s. With a stable career in public accounting and access to an employer-sponsored retirement plan, the initial steps were familiar, contributing to a 401k, reading investing articles, listening to recorded financial programs, and experimenting with individual stocks. Early stock picks included well-known consumer and industrial names, companies that felt familiar and safe. But the market environment of the early 2000s quickly tested that confidence. The technology bubble burst, markets declined sharply, and without a clear understanding of market cycles, fear took over. The response was a complete exit from individual stocks. Everything was sold at depressed prices, locking in losses that would take years to overcome. While contributions to the 401k continued, direct engagement with investing largely stopped. The lesson was painful but foundational. Reacting emotionally to market downturns can permanently damage long-term outcomes. The next major lesson came during the global financial crisis of 2008-2009. By this point, the portfolio had grown, but confidence remained fragile. When markets collapsed and headlines predicted financial ruin, fear once again dictated decisions. At the urging of colleagues convinced the market would continue falling indefinitely, the entire 401k balance was moved into a capital preservation option, essentially cash. While this felt safe in the moment, it proved catastrophic in hindsight. Markets eventually recovered, but the portfolio never fully caught up to where it would have been had investments simply remained in place. Compounding works both ways. When you sell at the bottom, you rebuild from a much smaller base. That single decision created a permanent performance gap that could never be closed. This experience solidified one of the most important investing rules. Never move long-term retirement assets to cash during a crash. Volatility is temporary, lost compounding is permanent. Years later, exposure to automated investing platforms brought renewed interest. The appeal was obvious. Diversified portfolios, automatic rebalancing, and freedom from emotional decision-making. These platforms promised to remove the need for timing the market entirely. While convenient, a critical issue eventually became apparent. Despite consistent contributions, returns lagged significantly behind the S&P 500. The same was true for the 401k. Both were delivering mid-single-digit returns during periods when the broader market was compounding much faster. At the same time, a large amount of capital sat idle in cash. This combination, underperformance and inactivity, became unacceptable. It triggered a shift in mindset. At a minimum, an investor should match the market. If a strategy consistently underperforms the S&P 500, there must be a compelling reason, or it should be abandoned. That realization led to a renewed focus on broad market index investing, specifically through low-cost S&P 500 ETFs, establishing the market as the baseline. The S&P 500 became the benchmark, the minimum acceptable standard. Any investment strategy that could not at least match it was no longer worth pursuing. This change simplified decision-making dramatically. Capital was redirected toward broad market ETFs designed to capture overall market growth with minimal cost and complexity. For the first time, the portfolio was aligned with long-term market returns rather than theoretical diversification or convenience. This shift marked a turning point. Performance improved, confidence returned, and the foundation for future strategy adjustments was finally in place. A long-term retirement timeline changes everything roughly. A decade ago, a deliberate decision was made. Retirement would not wait until traditional age milestones. A structured 15-year retirement plan was created, with clear targets and regular reviews. This planning horizon reframed every investment decision. The focus moved from abstract wealth accumulation to a concrete outcome: financial independence on a defined timeline. Mistakes still occurred. Some strategies underperformed longer than they should have. But the difference now was awareness. Market returns were monitored, benchmarks were respected. Adjustments were made when reality failed to match expectations. The most important insight was this: time and compounding are far more powerful earlier than later. Younger investors have an enormous advantage, but only if they use it intentionally. Discovering covered call ETFs as an income solution. As retirement planning became more concrete, the focus gradually shifted from pure growth to income generation. The question was no longer just how to grow capital, but how to convert it into sustainable cash flow without destroying the portfolio. Covered call ETFs emerged as a potential solution. At their core, covered call strategies involve holding an underlying asset, typically an index, and selling call options against it to generate premium income. The trade-off is capped upside in exchange for consistent cash flow. Initially, skepticism was high. Many covered call products underperformed their underlying indexes and suffered from long-term capital erosion. But deeper research revealed that not all covered call ETFs are built the same. Two funds in particular stood out: those that combined full exposure to the underlying index with disciplined option overlays and transparent rule changes designed to improve total return. Evaluating sustainability over yield. The key insight was that income alone is meaningless if the underlying asset deteriorates. Yield chasing leads to stress, poor decision-making, and eventual disappointment. The covered call ETFs that ultimately earned large allocations shared several characteristics: full ownership of underlying index shares, transparent option strategies, evidence of stable or growing net asset value, competitive total return relative to the benchmark. After prospectus changes improved execution, these funds began matching, or slightly exceeding, the total return of the S&P 500 while distributing substantial monthly income. That combination changed everything, transitioning from cash and bonds to income ETFs. Previously, large allocations to cash and bonds served as perceived safety nets. In reality, they dragged down long-term returns and failed to keep pace with inflation. Covered call ETFs replaced much of that defensive allocation. Instead of earning minimal yield on cash, capital was redeployed into vehicles that maintained equity exposure, generated monthly cash flow, preserved principal over time. This transition aligned perfectly with the early retirement goal. Income could be generated without selling shares, reducing sequence of returns risk and psychological stress during market downturns. Why not maximize yield at all costs? A natural question arises: if income is the goal, why not invest entirely in ultra-high yield products? Experience provided a clear answer. Products offering extreme yields often achieve them by sacrificing capital. Net asset value erosion becomes unavoidable, even if headline income looks attractive. Watching principal decline, even when distributions are high, creates emotional pressure and long-term risk. In some cases, it can take years just to break even. As a result, ultra-high yield products were avoided or kept to minimal allocations. Income was optimized within the constraint of capital preservation, not at its expense. Treating core income funds like a bank account, a useful mental model emerged. Treat core covered call ETFs like a high-interest savings account. The expectation is simple. The principle remains intact. Income is generated consistently. Growth occurs gradually over time. This framing reinforces discipline. Capital is protected first. Income is earned second. When that balance is respected, covered call strategies can function as reliable income engines rather than speculative tools. Managing risk through monitoring, not blind faith. Large allocations demand vigilance. Covered call ETFs are monitored continuously for signs of deterioration. NAV decline, reduced option efficiency, structural changes. capital being used to artificially support distributions. If those warning signs appear, alternatives are considered. Contingency planning is essential. No strategy is permanent. Adaptability matters. The role of broad market ETFs in the portfolio. Despite the heavy income focus, traditional growth ETFs remain foundational. Broad market exposure, particularly to the S&P 500, serves several purposes. Growth beyond inflation, participation in long-term innovation, benchmark accountability, capital appreciation for reinvestment. Some capital originally allocated to broad market ETFs was transitioned into income ETFs, effectively creating a growth plus income hybrid. But growth was never abandoned entirely. Selective growth and factor exposure beyond core holdings, smaller allocations were made too. Growth-oriented ETFs, momentum strategies, technology-focused funds, low marginal cost business models. These allocations serve as return enhancers. They introduce volatility, but also the potential to outperform the market over long horizons. One particularly compelling thesis centers on companies with low marginal costs, businesses that can scale revenue without proportionally increasing expenses. This model creates powerful operating leverage and long-term share price appreciation. Diversification. With purpose, diversification is not about owning everything. It is about owning different sources of return. The portfolio balances market growth, income generation, factor exposure, individual stock selection. Each component has a role. None exist by accident. Individual stocks, optional but powerful. Individual stocks are not necessary, but they offer upside for those willing to do the work. Careful analysis of earnings reports, financial statements, and management commentary can produce returns well above the market. Over decades, the difference between 10% and 20% annual returns is enormous. This effort is optional. Broad ETFs can deliver excellent outcomes, but for investors with the time and discipline, selective stock ownership can accelerate results. Taxes matter more than most investors. Realized tax efficiency plays a critical role in income strategies. Many covered call ETF distributions are classified primarily as return of capital. This defers taxation, allowing income to be received with minimal current tax liability. Taxes are only paid when cost basis is reduced to zero, and then often at favorable capital gains rates. Compared to selling appreciated shares or receiving fully taxable dividends, this structure can dramatically improve after-tax income. Preparing for retirement without selling shares. The retirement plan is intentionally simple. No forced selling for income. Core income funds provide monthly cash flow. Growth assets continue compounding. Partial reinvestment maintains portfolio momentum. With fixed expenses covered and a margin of safety built in, market volatility becomes manageable rather than threatening. Handling the next market crash. Market crashes are inevitable. The difference lies in preparation. With sufficient income and cash flow, there is no need to sell during downturns. Instead, volatility becomes an opportunity to reinvest distributions and rebalance. Fear loses its power when income continues uninterrupted. Habits that made the difference. The results were not driven by luck. They were driven by habits. Delayed gratification, high savings rate, career advancement, consistent investing, regular plan reviews. Wealth accumulation is rarely flashy. It is repetitive, disciplined, and often boring. Lessons for younger investors. Time is the greatest asset. Investing early, maximizing employer matches, and ensuring market-level returns can create life-changing outcomes. Complexity is unnecessary early on. Matching the market consistently beats most alternatives. Lessons for those starting late. Starting late is not ideal, but it is not hopeless. Aggressive saving, disciplined investing, and realistic expectations can still dramatically improve outcomes over 10-15 years. Final perspective. This journey demonstrates that investing success is not about perfection. It is about adaptation. Mistakes were made, some costly, but learning, adjusting, and staying invested ultimately mattered more than early missteps. By combining growth, income, and discipline, it is possible to design a portfolio that supports both financial independence and peace of mind. Not through hype, not through speculation, but through understanding how money actually works. In this in-depth conversation, we dive deep into the real-life investing journey of Trevor, a multi-seven-figure portfolio manager who is set to retire in 2026, well ahead of the traditional timeline most people expect. Trevor's story is far from perfect. It's a candid look at the mistakes, lessons, and pivots he made over 2 decades of investing that ultimately shaped a highly effective strategy for generating sustainable income without sacrificing principle.
Starting from his early days as a fresh college graduate navigating the dot-com bust, Trevor shares how initial enthusiasm turned to disappointment when market downturns wiped out his gains and forced him to rethink his approach. The financial crisis of 2008-2009 was a pivotal moment. Panicking and moving his entire 401k to cash caused him to miss one of the greatest market recoveries in history. That hard-earned lesson about staying invested and the power of time and compounding changed everything. Trevor's breakthrough came with embracing broad market index funds like the Vanguard S&P 500 ETF, VOO, as his foundation. But the real game-changer was discovering covered call ETFs, specifically the TAP alpha funds TSPY and TDAC. These funds combine steady principal appreciation with significant monthly income from option premiums, providing a consistent cash flow that fits perfectly with Trevor's early retirement plan. Unlike many high-yield products that promise big income but silently erode your investment capital, Trevor explains why covered call ETFs offer a balanced approach that preserves the portfolio's value while generating $300,000 plus annually in dividends alone. He walks through his rigorous evaluation process, the importance of understanding fund mechanics, and why he prioritizes stability over chasing maximum yield. Along the way, Trevor also candidly shares his regrets, including investing in Ulti, a fund that has not lived up to expectations, and emphasizes the value of patience, discipline, and continuously learning from mistakes. He stresses the critical importance of avoiding selling shares during downturns, consistently matching or beating the S&P 500, and thoughtfully diversifying to manage risk. Looking ahead to retirement, Trevor outlines a detailed plan for living off distributions without touching principal, continuing to reinvest some income for growth, and maintaining a diversified portfolio that includes growth ETFs like VUG, VGT, and SCHG to fuel long-term appreciation. His approach blends steady income with measured growth, striking a balance that many investors overlook. The conversation wraps up with practical advice for both younger investors just starting out and older investors looking to catch up. Start early, invest consistently, understand your portfolio's performance against the market baseline, and consider income-focused strategies like covered call ETFs when approaching retirement. This video is packed with transparency, real-world insights, and actionable wisdom for anyone interested in making their money work smarter, whether you're years away from retirement or planning to stop working in the next few years.